All right. Well, our next speaker is Kieren James-Lubin, another staunch supporter of the EEA. Great to see you again, sir.
Great
You
to
had
see you as
some
well.
reading all about you in the news. So a lot of exciting stuff going on over there at BlockApps. So congratulations. So I don't want to eat into your time. So I'll let you take off. You are up until what, 12:14, 12:15-ish or so. So it's all yours, sir.
Perfect.
Good to see you.
Thank you. All right, I'm going to go ahead and share my screen here. Thanks, James, for having me, the EEA in general. Thanks, everybody, for attending. Hold on. Here we go. Always full screening. I realized when I was just looking at my presentation, I have a little bit less of kind of general intro material, so I'll just say it at this point. So BlockApps, we are one of the founding board members of the EEA and have been focused on Ethereum for the enterprise kind of since the beginning, since folks were barely aware that enterprises would use blockchain technology. We have a product called STRATO, which faithfully implements the Ethereum protocol, but is standalone, so we don't actually write back to the public network or anything of that nature. And we're really focused around what we're calling Web3 commerce for business, which is really about taking real sort of business assets that exist today and putting them on blockchain technology. So we're less kind of creating new protocols, new things that didn't exist, 10, 15 years ago, much more focused on the legacy and kind of being a bridge towards getting all of that sort of extant real world value on our technology and on blockchain technology in general. So with that said, over the years, we've kind of seen the challenge, and this is sort of from a business perspective, distilled into what I guess I would call a transparency problem. So if you look at certain types of purchases, maybe in stock markets and all that sort of thing, you have a pretty good idea of what you're buying. There are people who are advising on what the stock price of companies should be. There are stated financials and all that sort of thing. It's pretty liquid. You can kind of get in and out of it. And if you look at sort of everything else, it doesn't really have that character. So it's difficult to see what the underlying quality of products or assets are. And so in some ways, that means there's no benefit to producers or sellers for doing the right thing with their products. And we've seen sustainability in particular as a big use case for us in the last few years. And just the big challenge there is understanding the data and understanding, okay, you're telling me it's, organic. You're telling me that certain farming practices were applied that reduces the carbon footprint, for instance. But consumers are increasingly demanding substantiation of that information. And so you also just see that, especially for certain high value transactions, there's just not a market infrastructure that supports just smooth trade, smooth commerce. And so that's what we're kind of aiming to create. And in doing so, increase the value of legacy assets, if you will. So our platform does all of this. So we're very active in supply chain settings where we can actually securely take an entire value chain that supports the production of certain products and verify all of the claims that are happening. So if it's, if someone says, again, it's sustainably sourced, what does that mean? If someone says, okay, certain, the type of labor that we used, it's child labor free, or, it's, we employ women or minority owned businesses somewhere in the value chain, we can actually substantiate that claim, which again is something that's increasingly being demanded by consumers at point of sale. And in doing so, we've created sort of general purpose infrastructure for transactions and are adding liquidity, which is increasing asset value to previously illiquid markets and just settings where people are trading. From a tech stack perspective, so STRATO is our blockchain platform, again, based on Ethereum. We've added certain additional components to it, as Connor mentioned, around privacy in particular. We've just found that enterprises were not willing to use public networks sort of as stated or as they were some years ago when we started on this journey, basically because they would have proprietary business data on a open public ledger, perpetuity. So we've created ways to permission the data so that you get the benefits of blockchain technology in terms of the proof of its authenticity, but not requiring them to reveal proprietary details like pricing or certain trade secrets, et cetera. We've also found that it's been very important to coexist with the current enterprise IT stack. And sometimes when our software is implemented, that part is harder than the blockchain part, so to speak. So we've developed a suite of APIs and middleware so that we integrate nicely into, say, a single sign-on system, into an ERP, into existing data stores where we might have to do a large data ingest to get the system up and running, et cetera. We've sort of tried to seal off all of the complexity of coexisting with the current IT environment in the enterprise at that layer. We've also, again, so asset tokenization is underlying everything we do. We have a set of sort of base smart contracts that just make it very easy to adapt any current business process to our system. So we started really working at the, some years ago at the lower strato layer, and increasingly have moved up the stack. So where we've found a concentration of demand, say in supply chain, in agribusiness, we've actually been able to build out a product called Trace Harvest, which is aimed at creating traceability and the seed and adjacent value chains. I'll talk a little bit more about that, and have moved on to, as I said, in the application layer, our end user is someone in the business who is tracking a current business process versus more of an IT person who's a user of Strato. I'll just keep going here. So just kind of key benefits and some distinctions of our approach versus others. So like other blockchain technologies, of course, we solve the double span problem and ensure that there's no, that assets are unique, real world assets are unique. And this really is manifested in sustainability recently, as there's a large concerns around greenwashing, whereby people are sort of claiming that certain carbon offsets have occurred and double claiming them so that they can sell those same offsets multiple times to different people. And we found, so we didn't set out to create a low carbon blockchain per se, we set out to create a performant blockchain. In doing so, we made some changes to the core consensus algorithm and some of the ways that transactions are processed to handle higher throughput, lower latency with fewer computers. Added benefit of that is a much lower carbon footprint than you see in most public blockchains today. Verified identities, I want to talk a little bit more about this idea. So I think we found over the years that in a business setting, you're pretty much always going to know the identity of a direct counterparty. Now there might be third-party subcontractors or other, there's plenty that is not visible to you, but usually when you're doing business with someone, you kind of know who they are, and you really need to and want to, just in the case that something goes wrong, first you have to sign a contract with them, so you need the identity for that, but also enabling legal recourse, right? That's something that's been missing to a certain degree in the public blockchain world. And there are cases, again, where you do want pseudonymity, but when we're restricting to the business segment, we've typically found that that is not the case. So on the one hand, businesses want the transactional privacy that I was talking about, and I kind of cover later in this slide. But on the other, they really just need to know who the other side of the transaction is. And we've actually started to bake that into the system kind of more natively with kind of some extensions at the Solidity level and to the blockchain itself. I'll kind of skip through, actually, I'll talk about the last point. So one of the things we've been seeing in the kind of NFT revolution is that the idea of kind of longer lived residuals, if you will, has gotten out there where, say it's a piece of digital art, an artist will create that and will, for each subsequent sale, and still continue to reap some small percentage of that purchase price after the initial sale, which is, so far as I know, not really been seen before in business today. And we've actually taken that idea and applied it in other contexts. So say a key data point is required to make a consumer facing claim. Like, you say you're a food manufacturer, and you want to claim that certain of the ingredients you have were appropriately sustainably sourced, and the farmers used no-till practices when they produced that ingredient. So what you can do is actually, having initially taken the data that supports the claim that you're making, in some cases, as further down in the supply chain, there would continue to be a residual paid back to that original farmer who offered the data in the first place. So, and it's actually a quite flexible system. We find that in complicated value chains, there are rebate structures that are very complicated as well. And so our system's flexible so that it can support what people are doing today, but also offer more benefit in the case of sort of premium products to folks that help support that premium, if that makes sense. So moving along, we have a flywheel, if you will, here, where we're taking real world assets and tokenizing them. We're increasing the value of those assets with what we're calling transparency data. So data, again, that supports claims that people are making to consumers, and these could be consumers, or in a more complex transaction, could be a business on the other side, but really just the buyers who want to know more about the underlying product or asset to be able to quickly make a purchase with confidence. And then we've talked about sort of the value chain incentives in the previous slide, and those are supporting follow-on exchange in the value of those assets or products. So again, a couple key use cases here, and I'll kind of be mindful of the time. So I'll go into probably one or two of these categories, but not all three. So value chain traceability, we've talked about. So securely sharing data across the whole value chain for the life cycle of products and assets in support of premium pricing, basically premium product management. But again, we're just finding that decommoditization all over the business world. So where before, a bushel of grain of some kind was always just a bushel of grain, soy, corn, etc. We're starting to see different varieties that present at sort of end consumer point of sale and having different price points. And so we are supporting those, in some cases, price premiums with data proving that, okay, it really is a specialty product. Inventory management also, just in complex value chains, a lot can happen. So popular use cases there are returns, recalls, that sort of thing, where you've got a need for more precise identification for products in a downstream value chain and kind of when they come back. Actually, you'd be surprised that the level of traceability that's present, and it's not usually all that high in most value chains today. So on the sustainability tracking side, really our journey, we started sort of with supply chain traceability, but it's kind of rolled into sustainability as a broader bucket. I'd say sustainability is the biggest growth area from a use case perspective for us. It's not the only one, but really it's about emissions for us right now. So we've got a good footprint in the energy sector where lots of the big companies are under quite a bit of public pressure to improve their carbon footprint faster. And so much so that Exxon has some new activist board members. Shell, about a year ago, was told by a court that it needs to lower its carbon footprint faster than it currently was. And it's also consumer pressure as well. Again, you're starting to see a preference like for low ethanol crude for at the pump, low carbon intensity crude. So it's really kind of coming from all sides. And again, what it's about is understanding the underlying data in a complex value chain. And in doing so, making claims to your end users, consumers, they could be, again, big businesses, they could be individuals, that support your differentiation as a big business. We've also moved into the kind of emissions and offsets management part of this. So first, we're sort of capturing the data that supports calculating the carbon footprint and making sustainability claims. In certain cases, that data is supporting the claim that an offset has occurred. And we also allow kind of assignment of those offsets to other parties, allowing measure of carbon offset trading as well. I believe I have 2 minutes, so why don't I pause here just in case there are questions.
Yep, you definitely have 2 minutes, and I'm looking at my one chat. I don't see questions. Do you see any on yours?
I don't think so.
Yeah, I don't see anything on the site either. If anyone has any questions, please put them into the chat box.
Somebody by the name of Jordan Sutter says, "Hey, Kieren."
Hi, Jordan.
I'll give a shout out to Jordan.
All right.
Yeah.
With that said, maybe I'll discuss the last column and I'll close on that.
Sure.
So we're mostly working with physical assets, and I would say we're almost entirely working with legacy assets, things that again existed before the blockchain revolution. There are interesting cases of what I've called intangible assets here. So we have customers using us to manage invoices. Invoices are something that everyone sends, and there's always some measure of collection challenges, and sometimes those are related to data supporting whether the contractual delivery has actually occurred. And so that's a popular use case for us, especially in kind of the engineering, project management, construction space, where you may have projects with a couple hundred people, and you get into maybe payment disputes is the wrong word, but there are payment delays because it's not clear to each side what milestones have been achieved. And so you get into this data reconciliation mess that, in a sense, reduces the value of the invoice. So if you had more supporting data kind of coming with the invoice, reconciling everything, it itself could be more liquid. So a lot of industries run on factoring. Factoring is basically, if you invoice someone, a bank or a specialized factoring firm would advance you, say, 80% of the face value of the invoice, and that's what your operating cash flow kind of runs on. So if you have more data supporting the quality of the invoice, potentially you can get a better rate for what in fact are the interest payments on that factoring effort. So again, we see an example of higher quality data supporting claims that support asset value. And I guess I'll close on that. I've taken the last 2 minutes, it looks like.
Yeah, no, appreciate it, Kieren. A couple questions did pop in from an Oliver Murray and Jeremiah Coffey. You guys can shoot a direct message. You can click on Kieren's profile, and Kieren, maybe just check that chat feature on your profile, and maybe you guys could connect off there. I just want to give Ibrahim, but Kieren, great to see you. Great information. Always a pleasure to have you. So all the best to you and your team. Thank you, sir.
Great to see you as well.
All right.